What's up, everyone? How you guys doing? Welcome back to a new videos right here on my channel. On this video, I'm going to talking about the ICT or SMC. I've had a couple of messages on my DM asking me, do I trade ICT? Do I trade SMC? Now, I've made similar videos like this in the past where I show the strategy of SMC and ICT, right? So I'm going to be talking about a few points that clarifies the difference between ICT and SMC, right? These are my own personal opinions. Does not necessarily mean they are 100% right. You might have yours, and just take this as an education and filter out what you think you don't like, right? Let's get straight into it without further ado. So what is ICT or SMC? Like, unlike retail, retail support resistance, you can have, different things attached to it. But when it comes to ICT or SMC, there might be some kind of similarities and differences as well. A lot of ICT trader things they trade SMC, a lot of SMC trader things they trade ICT, and they feel like both are the same. Now, for clarity purpose, ICT itself, to me is more like the foundation of the whole institutional trading, but then there are so many misconceptions about these two strategies. Now, I have traded ICT before. I started with ICT before transitioning into SMC. I've said that multiple times, and I'll give the reasons why I transitioned into SMC. ICT works for me at that point in time, but I just wanted something that I can work with, right? And this is where we get to go into what ICT actually means. So ICT is an acronym meaning the inner cycle trader, while SMC simply means the smart money concept. So both names, inner circle trader, what SMC means the smart money concept. Inner circle trader is really not a strategy name. It's more of like the founder of, the institutional trading on its own, which is Michael Hudson. He talks on his YouTube channel where he talks about the inner circle trading, courses and everything. And here we will look at some similarities and differences between the smart money concept and the ICT circle trader. So the most common questions from new traders trying to find an edge in the market, getting confused on what strategy they should take with. This video is to clear some similarities between the ICT and SMC strategy. So one of the things you have to understand when you are trying to get the differences between the SMC and ICT is understand the basics. Without basics, you are lost. So you need to understand what does this strategy actually point into? What did they talk about? And when you know what each of these strategies actually point into, you'll be able to filter out the right information from the wrong information. So now there are basic things to get familiar with when trading any of these strategy. Example are the most common ones, which is the turtle soup, the OTE, which is the optimum trade entry, the other blocks, the fair value gap or imbalances, the supply and demand, the inducement, the sell side liquidity, the buy side liquidity, the SIBI and BISI, which is sell side inefficiency, buy side imbalances, something like that. So you have to understand that these names are attributed to each of the strategy. So just like ICT has the total soup, the OTE, the other blocks, the fair value gaps, the sell side imbalances, the buy side liquidity. Also, the SMC strategy has the supply and demand, the inducement, the liquidity target, all of that are based on SMC. They are being used on SMC. You have the stop ons, it's used by SMC. You have the liquidity graph, it's used by SMC. You have supply and demand levels, they are used by SMC. Inducement, SMC. Engineered liquidity is also an SMC term. So when you try to differentiate what this is in terms of the terms that are being used, then you can start to view the level ground from the two. So one of the things you should get to also understand is that even though the names might sound different, they are both like similar when they are coming to application. An example is turtle soup. So you might not know what turtle soup is. Turtle soup is not like a manipulation phase. When market is building up like this, and we have so many build up of liquidity, what turtle soup means is that we can have a kind of manipulation to the upside. In most cases, or in the old days of ICT, it talks about 20 pips, in London sessions where price could go back down. So this movement itself is referred to as turtle soup, which is known as manipulations. So for ICT, it may be referred to as the turtle soup. For the SMC strategy, it's maybe referred to as stop point or the liquidity graph. You can see that both are actually similar in terms of the technical analysis. But when it comes to the grammars and the English being attached to this both strategy, it tends to be like they are different. But you can see it from that aspect that they look similar. The next one is we look at the OTE, or we can also have what we call the RTO, right? The RTO is known as the return to order block, which is also a basic terms in ICT. The return to order blocks is an area where we have the turtle soup and the leg that actually took out liquidity. We expect price to go back into it and react off the order block that actually took liquidity. So the process at which price goes back is referred to as return to order block, which is also a very, very common ICT terms. So when it comes to optimum trade entry, which is actually an entry, Fibonacci tools, which is used for entry on ICT. In most cases, OTE is not being used in SMC. There are other strategies or entry models that are being applied to SMC, right? So we can always see the same thing in other blocks, the fair value gap. But one of the things I would like to actually put emphasis on is the fact that for ICT, we do not actually use the supply and demand. ICT in its own course doesn't talk about the supply and demand. No, it doesn't talk about that. Anyone talking about the supply and demand is just adding an addition of what ICT does not talk in its concept. But in SMC, there is always supply and demand in equations, right? We have the inducement in equations when it comes to SMC. We have the other block as well, similar things with ICT. We have the fair value gap or imbalance. Both are also present in them. Now, what you need to also understand is this concept are similar. You can start to trade ICT and transition just like myself into SMC. You will always have the same approach into the market. Now, what is being prioritized is going to be the next one, which I'm going to explain to you here. Note that there may be misunderstanding of liquidity concept when trying to compare both in the manner at which price action is read. ICT prioritize the algorithm delivery of price, right? That's its priority. Price is being delivered by the algorithm, like it has been programmed to deliver price at this time. At this time, price should react this way, while SMC prioritize the order flow of price, which is essential with market structure. Now, I should remind you that in ICT courses, it talks about following what price is doing at a point in time, which is at a particular time, you have to be, let's say, if you're trading York session, there is a fixed timing on, silver bullets, which he has talked about, the delivery of price, things you should expect at this particular time of the day. Those are ICT algorithm delivery of price. So while SMC prioritize the order flow of price, which is essential with market structure. So there is always an in-depth understanding of market structure when it comes to SMC, because that seems to be the more foundational basis of SMC. However, what is common between both is price targeting areas of liquidity. Now, you have to understand that what both traders actually tends to look at for is areas of liquidity. Where exactly is price getting into and how do they capitalize on this price movement? So then in ICT, you can talk of the old highs, the old lows, the fair value gap, the inefficiencies, and all of those things. So fair value gap is also a term for inefficiency, the inefficient delivery of price. So in the cases where we have inefficient delivery of price, you can always wait for price to trade back into those areas to fill orders. So you can see that there is a kind of similarities there, but really kind of there's a slight differences between them and what they look at to target. So also the concept of mitigation seems similar, but the entry models applied to both seems different. So when you look at mitigations is just like what we explained earlier on. In the case whereby we have buildup of liquidity in these areas, and we expect price to take our liquidity and we start to build up lower. Mitigation is when price come back into these areas to mitigate this area, which means to tap into an unfilled order. So the process whereby price come back into this area and sell lower is called mitigation. It's the process whereby price move back to its main sources of volume and filled some unfilled orders. We have some pending orders right there that price comes to fill, then we continue the sales. So that process is called mitigation. From the way I explained, you would see that there seems to be a kind of common things with ICT at SMC. Now, when I talked about me transitioning into SMC from ICT. Now, ICT traders prioritize entry from fair value gap, while SMC prioritize entry from supply and demand areas. Now, this is the difference between them in when it comes to entries. So when it comes to entries like this, in a case whereby you have build up of liquidity and price start to, give a kind of build up where we have fair value gap in these areas. So ICT traders, we prefer to enter trade from fair value gap. So this area is called fair value gap, where there is inefficiency in price. So ICT traders, we prefer to have their entries at the fair value gap. So this is fair value gap, and they will have their stop loss at the highs, which is going to expose their SL to a very wide LSL, at most 1 to 5, 1 to 3 for those entries. But when it comes to SMC entry model, SMC prefer to refine into the last downward candle or into the last upward candle in case of sells before the sell. So for SMC trader, we tend to go for more refined positions. So you wait for price to pull back into these areas, then we can look for sells at the last candle, which means more refining into your areas, which is going to lead to more risk to reward and using tighter LSL. So these differences is because of the entry model as well. So for ICT traders, they prioritize fair value gap. For SMC traders, we prioritize, a very good refining. So the common mistakes with this is that when it comes to over refining trades, you tend to miss so many trades. But the sacrifices is worth, catching one trade than, catching so many trades. That is fine. So you would see that there are a lot of differences, but there tends to be a lot of similarities as well. Even though there are slight differences within these two concepts, there seems to be similarities. So my advice is, if you decide to learn ICT, of course, it's a go ahead. It's something you can go ahead to do. You always find what works for you. If you decide to go with smart money concept, there is always something that will work for you. So for me personally, there are reasons why I had to transition into SMC and into ICT. So this has to do with personal reasons. Number one, trying to look for refinement, trying to understand a particular instrument, USD at that point in time. I was just focusing on refining my edges, looking for a trade of 1 to 10, a trade of 1 to 3 or 1 to 5, because I want to just be clinical with my entries. And also what I noticed about, ICT traders as well is understanding, at that point in time, at a price, it also prioritizes the concept of price and time. Also, SMC traders does the same as well, but not as understood by ICT traders, which is a concept of price and time. This concept is actually well explained in Silver Bullet. It might not be known to ICT traders, but price and time is also a concept in a Silver Bullet strategy. So I feel like if you decide to learn ICT, it's a very good go-to strategy if you want to learn. But this is the thing. Both concepts prioritize liquidity as their objective. So there is always an objective in price for what you want to look at for. Just like areas of liquidity on ICT can be old highs and old lows, your areas of liquidity in SMC, those old highs and old lows are referred to as inducement area or engineered liquidity. So we can also see there are kind of ways we can attach, in short. So I don't want to make this video longer than it has been. So what you need to understand between these two is that one has been refined. So the refining of ICT is what bet what SMC. So a lot of refinement has come into ICT, which has bet SMC. So I would say SMC is from ICT, but now it has been more refined into something a lot of people. And that is why a concept is not really an 100% strategy. A concept is something a lot of people have worked on to build up their own particular trading plans or trading rules to make up a strategy for them. Since SMC is a concept, anyone can utilize it. You can use, Elliott wave with your SMC. You can use, you can also use Fibonacci tools in your SMC. It's a concept. But when it comes to ICT, it stands alone. It's a strategy that stands on its own without having to add or subtract from the strategy itself. So I do hope with these few points, you would be able to understand the basic differences between the SMC and ICT, and you don't have to get yourself, warm up into which of these ones should I go into. You can as well start learn ICT and still have an understanding of SMC. If you understand this both approach in terms of their entry models, you could always get involved in trade in and out and just to make money. At the end of the day, the idea is to make sure you make money and not to show which one is the best or which one is not. I wish you guys good luck and see you in the next one. Good luck and God bless you all. Peace out.